Welcome back to the season finale of Keeping Up with Thandi. And out of everything one has to remember to do in school, never forget to breathe. It can be overwhelming trying to have everything under control, and sometimes it may take up almost all of your time. Don't allow it to. Manage your time in such a way that it will always ensure that you have enough time to yourself outside of hustling. We are not supposed to let life pass us by while we are focused solely on our education. Every moment of our lives should be enjoyed with laughter and fun. When you look back to your university years one day, you must be able to say it was a difficult time, but I had some of the best moments of my life, because sometimes that's all that matters. Life is uncertain and anything can happen or not happen. Despite all that, be sure to have the time of your life. Before we close off, let's look into risk and return. Business risk is the uncertainty that a business might not be able to cover its operating costs. The level of business risk is driven by the firm's revenue stability and the structure of its operating costs, which can be fixed or variable costs. The effect of business risk on financial performance could be measured by the variability of its earnings before interest and tax. The more variable the earnings before interest and tax of a company, the higher the business risk. Operating break-even point is the level of sales necessary to cover all operating expenses. At the operating break-even point, the earnings before interest and tax equals 0. Operating break-even point equals to fixed cost divided by the contribution per unit. The degree of operating leverage measures the sensitivity of changing in earnings before interest and tax to changes in sales. Only companies that use fixed costs in the production process will experience operating leverage. A company's degree of operating leverage can be calculated in two different ways. One calculation will give you a point estimate, the other calculation will yield an interval estimate of degree of operating leverage. Point of estimate of degree of operating leverage equals to contribution divided by earnings before interest and tax. Care must be taken when using the point estimate because the degree of operating leverage will be different at different levels of sales. Financial risk is the chance that the firm will be unable to cover its financial obligations. The level of financial risk is driven by the predictability of the firm's cash flows and its fixed cost financial obligations. Financial leverage results from the presence of fixed financial costs in the company's income stream. The degree of financial leverage measures the sensitivity of changes in the EPS to changes in earnings before interest and tax. Interest payments equals to risk, as it is payable regardless of performance of the company. Point estimate of degree of financial leverage equals to earnings before interest and tax divided by open brackets earnings before interest and tax minus interest close brackets. If the degree of financial leverage is greater than 1, it indicates the presence of debt financing. In general, the greater the degree of financial leverage, the greater the financial leverage and the greater the financial risk. Total company risk is the degree of combined leverage as indicator of risk. Total leverage results from the combined effect of using fixed costs, both operating and financial, to magnify the effects of changes in sales on the firm's earnings per share. Operating leverage and financial leverage combined create the degree of combined leverage. Now to calculate expected return is the return on a risky asset expected in the future. In calculating the variance, first you need to determine the squared deviation from the expected return, multiply each possible squared deviation from its probability, add these up, and the result is the variance. The standard deviation, as always, is the square root of variance. Looking into announcements and expected returns. Expected returns formula is as follows. Expected return plus unexpected return. An announcement can be broken down into two parts, the anticipated or expected and the surprise or the innovation part. Announcement can be equal to expected part plus surprise. The expected part of any announcement is the part of the information that the market uses to form the expectation of the return on the equity. The surprise is the news that influences the unanticipated return on the equity. Systematic and unsystematic components of return. Actual returns break down into expected and surprise components, whereby the actual return of the year equals to the expected part of the return plus the unexpected part of the return. Now recognize that the total surprise component of the unexpected return has a systematic and an unsystematic component. The calculation would be expected return plus systematic portion plus unsystematic portion. It is important to use the Greek letter epsilon portion and the letter M to stand for the systematic part of the surprise. The unsystematic portion is more or less unique to the company. For this reason, it is unrelated to the unsystematic portion of returns on most other assets. The principle of diversification. Spreading an investment across a number of assets will eliminate some but not all of the risk. Unsystematic risk is eliminated by diversification, so a portfolio with many assets has almost no unsystematic risk. The total risk of an investment, as measured by the standard deviation of its return, can be written as total risk equals to systematic risk plus unsystematic risk. Systematic risk is also called non-diversible risk or market risk. Unsystematic risk is also called diversible risk, unique risk, or asset-specific risk. For a well-diversified portfolio, the unsystematic risk is negligible. For such a portfolio, essentially all of the risk is systematic. This closes risk and return.